dialing in a little bit early, we're going to get going with the program. And here we go. So good morning and welcome to a special Private Equity Career News webinar, Winning Origination Strategies for a Dynamic 2022. I'm David Toll. I'm the publisher of a weekly newsletter, Private Equity Career News, and I will be your moderator for the program. I'd like to start out thanking our sponsor, SBS by Bain & Company. They are an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. A few housekeeping announcements before we get into the heart of the program. First, a friendly reminder to any reporters who are on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything that they say today in an article. Second, you can download a copy of today's slide presentation from your control panel. There's a handouts drop-down. You can also download a copy of the results of a survey of business development professionals. This was a survey done last year, and it includes valuable information on industry practices. Next, I will send everybody on today's program a recording of the full webinar, so no need to take extensive notes. And finally, many of you asked good questions when you registered for the program, and we will plan to address those during the discussion portion. Please also feel free to ask questions at any time during the program through the question feature on your control panel. So let's get to introductions. I'm grateful to have 4 expert speakers today to guide you through the topic. Starting with Nadim Malik, is founder and CEO of New York City-based SBS by Bain & Company. Nadim is going to present statistics revealing the state of the M&A market as we turn into this new year, and also address the role that technology plays in helping deal originators see a higher percentage of relevant transactions. We have Kelly Lineberger. She is partner and leader of business development at Charlotte, North Carolina-based mid-market buyout shop Ridgemont Equity Partners. We have Larissa Rosicki. She is a director in the Cleveland office of mid-market investment bank that you've all heard of, Harris Williams. And we have Adam Stormone. He is managing director in the Minneapolis office of another well-known mid-market investment bank, Cascadia Capital. So let's find out a little bit more about our speakers before we launch into the heart of the discussion. Kelly, why don't you start? Tell us a little bit more about Ridgemont Equity Partners, your strategy, and your role there.
Sure. So Ridgemont has been around as an investment team for nearly 30 years now. We have invested over $5.5 billion across over 165 different companies. Today, we're focused on 3 main sectors: business and tech-enabled services, industrial growth, and healthcare. I've been with Ridgemont for 12 years now, with that whole time focused on sourcing, so originating investment opportunities for our flagship funds, as well as add-ons for our portfolio companies. And then along with that, managing a broad set of relationships with transaction partners, from debt providers to executives. Spend a lot of time with M&A bankers, and then other people in the M&A community that help us find deals and be well positioned.
Thanks, Kelly. Larissa?
Thank you, David. Harris Williams is a mergers and acquisitions advisory focused investment bank. We have been around, actually recently just celebrated our 30th anniversary, founded by 2 gentlemen in the early 90s, and you fast forward to today and we now have a very talented team of over 400 professionals across 8 offices around the world. We have 10 dedicated industry group practices focused on just about every aspect of industry and economy. And my role within Harris Williams is primarily focused around opportunity identification and deal origination efforts.
Thanks, Sarissa. And Adam?
Yeah, thanks, David. So Cascadia Capital is a Seattle, Washington-based M&A advisory firm. We've been around for about 20 years, and we have offices in addition to Seattle, Los Angeles, Minneapolis, and most recently Nashville. I'm a managing director in the healthcare practice, one of 5 industry verticals that we have at Cascadia Capital. We are focused on working with closely held family businesses and entrepreneurs and helping them think through their strategies as it relates to liquidity event, or in some cases, institutional capital raising. We've grown quite a bit, like a lot of firms, over the past couple of years. From a size perspective, we closed 51 transactions as a firm in 2021, which was up pretty substantially from the downturn in 2020 at the height of the COVID pandemic, and I'm sure we'll talk a little bit more about that today. Within the healthcare practice, we closed 12 transactions last year and continue to add people and grow within our markets. Our focus again is really closely held family businesses, middle market businesses, entrepreneurs. From an enterprise value, we're doing deals really between 50 to 75 million on the low end, up to 400 or 500 million on the high end.
Thanks, Adam. And okay, let me turn it over to Nadim to introduce himself and also to go through a short presentation shedding light on the state of the M&A market. Nadim?
Good morning, everyone, and thank you so much for joining us today. 2021 was definitely one for the books, a year all of us, I think, are going to remember. As a data analytics company, this is a great time of year for us, Frank, because we can now crunch the numbers and look back at trends and key takeaways of the year, which I look forward to sharing with everyone this morning. My personal view is that there's going to be a huge shift in deal activity, especially as we look at Q2 and beyond, something I look forward to getting our panelists' view on as well. And at SPS by Bain & Company, we're continuing to do what we do best, which is helping our clients position themselves for deal sourcing opportunities in any market using data analytics, technology, and automation. Coming off a record year for deal volume, now more than ever with increased competition and potentially fewer deals, this is a critical time to get strategic around your deal sourcing. I think those that do will be very glad come second half of the year. Before turning things over to our expert panelists, I wanted to spend the next 10 minutes or so with some slides to help frame our conversation. So with that, let's go ahead and get started with deal volume. In case you hadn't heard, deal activity was way up last year compared to the prior year. We surpassed 10,000 deals for the first time. This is in the US or Canada. Control and minority transactions by private equity and strategic buyers of at least 10 million of enterprise value and greater. Private equity was up 36% and strategic activity was up 24%. But something much more significant happened last year, almost quietly, sneakily in the backdrop of COVID and everything else going on in our busy lives, which is this. PE activity represented a higher share of overall M&A activity for the first time ever. You hear a debate going on sometimes about Wall Street and Main Street. Well, I guess it's official. Cue the confetti, David. Cue the fireworks. Wall Street has officially taken over Main Street. Game over. Moving on to the next slide. This growth, or takeover, if you will, is due in part to the increasing trend of buy and build and roll-up strategies, which continue to grow in 2021, with PE firms completing 2.3 add-ons for every platform during the year. Further to that point, we're seeing a growing trend by PE firms and BD professionals, especially as they get more sophisticated in their own sourcing efforts, to get more involved in add-on sourcing for their portfolio companies and not just leaving it to their management teams. It's a vital part of their growth targets, and they can definitely complement their efforts here. Moving on to the next slide, let's look at closed deal activity by quarter. Q4 last year was a peak, just inches past the 2019 levels for Q4. Q4 2021 will definitely go up due to data lag. We're still collecting deal announcements and information that's going to continue here for the weeks and months ahead. But I believe it's safe to say that it won't surpass last year's record high in terms of deal closings. Moving on to the next slide, which breaks down the most active sectors for private equity for 2021 compared to 2020. Service businesses are at the top spot, followed by IT, healthcare, and industrial, and pretty much growth in private equity activity across all sectors. No surprises there. Moving on, in case you haven't heard, PE deal flow really went through the roof last year, and our data certainly backs that up. Deal flow in Q3 2021 was the highest we've ever seen by far, towering past the record set in the prior quarter, second quarter of 2021. But look at those Q4 numbers. We really had to rub our eyes and double check multiple times on this one. And while they may be subject to some adjustments, slight adjustments, these are the numbers. And I'd be curious to hear from the panelists once we get into the Q&A if this is consistent with what they've experienced and kind of how they interpret this drop in deal flow. Moving on to the next slide, a lot going on here. Let's start at the top right, which shows the most active private equity firms in terms of new platform investments as well as exits last year. On the top left, privately held companies continue to represent over 60% of all new platform investments made by private equity firms. And moving on to the bottom left, we definitely see a trend forming when it comes to PE exits. In 2021, 37% of PE exits went to corporate buyers, and 63% went to private equity firms, either as new platforms or add-ons for one of their portcos. So this is a trend I think will need to continue for the seller side of the equation to keep up with buyer demand as more private equity holdings come to market. Moving on to the next slide, knock on wood, if things continue positively, travel should be more of a thing in 2022 and moving forward. But you need to know where to go. The intermediary landscape may have shifted, as well as the sponsor landscape if you're an investment bank or have a sponsor coverage model, a lender, what have you. New firms have come up, professionals have shifted locations. Within the SPS portal, with a few clicks of the button, a heat map can be created like this that shows you all the locations and concentration of the deal sourcing professionals that are most relevant to you. And then once you've decided where to go and prioritize your calendar, you can literally just, drill into, like it's a Google Map plug-in, drill into the city, plan your trip. And then our mobile app even has the geospatial ability. So when you're in that city, let's say your lunch cancels, you can see that Adam or Larissa or Kelly are right up the road. Let me see if they want to drop in and, have a coffee or something like that. So moving on to the next slide. Direct to sponsor sourcing has become a core part of our firm's value proposition and the way that we're working with our clients from an origination standpoint. According to our data, over 5,100 companies bought between 2013 to 2018 are still being held, and logic dictates are going to need to come to market in the months and years ahead. Within the portal, here you see the breakdown by top private equity firms that have those holdings, a high-level overview of those sectors. But within the SPS portal, you can sift through all the granularity, deal sizes, sectors, geographies, maturity of the company, even the PE professionals whose portfolio it's in, as well as contact info and warm intros into them through this deal connectivity functionality that we have. So we can really work with our clients to get smart and more proactive on this sourcing channel. Moving on to the next slide, here's who sold the most companies to PE buyers in different size ranges in the US or Canada last year. It's just amazing how much this varies purely based on size range adjustments. And you know how flawed it can be to just rely on published generic league tables or data feeds to determine how to prioritize your time from a sourcing perspective. You need to have this not just by size range, but other deal attributes that make them relevant for you: sector, geography, control versus minority, special situation, broad versus limited processes, to help prioritize this list, and then layer in your coverage. So what share by those firms did you see that are relevant for you, so you can really fine tune and prioritize your outreach moving forward. So you can see how these firms are so different in terms of activity on the sell side, and a very similar perspective would be rendered on private equity firms and other M&A advisory firms as well. Finally, I'm very excited to announce our latest product development enhancement. Our parent company, Bain & Company, based on the decades of work they've done consulting with private equity firms, have developed a proprietary industry taxonomy that solves a very, very real and difficult challenge. You know, having been in the financial information services space, collecting this type of information for several decades, there's a lot of different industry coding systems, industry trees, but they can be very imperfect. The fundamental challenge is, you know, what good is data or information if you can't filter it or cull it for your target markets? So I'm happy to say that this new industry taxonomy has several layers, and at the sub-industry vertical level is over 560 subsectors deep. And all of our 80,000 plus transactions have now been restated into this new taxonomy. Historically, our analysts have been trained on it and are applying it moving forward. And the last step of the process is to now update our client-facing UI, data sets, training to roll this out. We're very, very excited about this coming out next quarter. I think it can be a real game changer in terms of how you can slice and dice the data and gain valuable perspectives. So with that, I will thank everyone for their time. I'm really looking forward to a healthy dialogue with our panelists, for which I'll turn it back to our moderator, David.
Okay, Nadim, really good stuff. So interesting to see private equity firms account for such a high percentage of exits compared with 5-10 years ago. Just says so much about the growth of the overall market, the industry. So so let's see. I'd like to now move into the discussion portion of the program, and this is where we're going to address questions that registrants asked when they signed up, and we're also going to take your live questions. So please avail yourself of the question feature on your control panel. Just ask away at any time, and we'll get to your questions. Before we do that, I do have a couple of polling questions I want to ask to take advantage of an exceptionally large crowd on this program, and we'll see what the market says on these big questions. So give me a moment to tee it up. The first question is, how do you expect the number of platform deals that you close this year to compare with last year? So I'll repeat that. Okay, so you should see it on your screen. How do you expect the number of platform deals you closed in 2022 to compare with last year? I'll give you another 5 seconds or so to answer. Okay, I'm closing the poll and sharing the results. Let's see what we have here. Okay, so the most popular response, a plurality of you feel that you'll do about the same number of platform deals this year as last year. And so I would call that optimistic. And then another 40%, which is a pretty high number. I expect the number to be up this year, either 10% higher or even more than 10% higher. So lots of optimism from the audience going into the new year. And let's go to my second and final polling question. And this is closely related, and it's the same question, except it has to do with add-on deals. And the question is, how do you expect the number of add-on deals that you close this year to compare with last year? So go ahead and give you another few seconds to answer. Okay, and here are the results of that poll. So very similar, although, so again, the plurality, actually the plurality says up 10% higher than last year. So that's the most popular response. And so it looks like in general, folks are expecting to do even more add-on deals this year than platform deals in terms of increase. So, okay, gonna hide the results and let's move into the questions that I have for the panelists today. And we're gonna start with some big picture questions, and then we'll gradually get into some more detailed questions. First question, what industries and subsectors do you expect to generate deal flow, the most deal flow for private equity firms this year? Larissa, where are the hotspots going to be?
Well, at the risk of maybe being viewed as trying to skirt this question a little bit, I think we're going to see a pretty robust market across the board. When we think about, coming back to my opening remarks about Harris Williams, we have 10 dedicated industry groups, and in 2021, all 10 of those practice areas set records in terms of deal activity for our firm. So as we think about where folks are really going to be concentrating, I don't mean to sound cavalier to say we think it's going to be everywhere, but there really are a lot of points to to see that that's going to continue and that trend's going to continue into 2022. When you start kind of drilling in, I think if you really want to kind of paint me into a corner a little bit about certain sectors that could really be interesting, healthcare, technology, consumer, kind of direct to consumer businesses really have represented a pretty strong share of market activity. Businesses that are sort of asset light and service oriented businesses have continued to see an uptick in terms of performance, deal volume. Certainly how they fared during the pandemic obviously helped that. So there are certain areas where I really do think that there's going to be strength, but generally speaking, the overall, market sentiment is going to be, very opportunistic for, for almost every practice area.
Okay, so that sounds all good. Adam, you're focused on healthcare, but healthcare is a universe in itself. So tell us what you're anticipating.
It is a universe in itself. There's a lot of different subsectors within healthcare. I'll maybe, and I would agree with Larissa that it'll be broad-based. I think when we think about things from Cascadia's perspective, we tend to be a little bit more technology-focused and forward-thinking about where things are headed from a broader macroeconomic perspective. And one of the things we did as a firm to get ahead of that is we launched a sub-industry group within industrials and technology called robotics, automation, and AI. And so we're seeing a lot of activity sort of in this next industrial revolution in terms of automation within a lot of different types of businesses. And so we think that's an area that will continue to see some growth and activity. And there's certainly applications, David, to that within the healthcare space. If you look at what we've done as a firm, we've done a lot of stuff in and around digital health. There's just a lot of disruption happening, a lot of really interesting companies that are coming out of the pandemic, whether it be telehealth, whether it be interoperability. And healthcare has historically lagged behind other other industries and technology adoption, and we're seeing a catch up happening now. So we see quite a bit of opportunity within the healthcare space, certainly within healthcare services and physician practice management businesses. We continue to do a lot of stuff in that space, and then we're doing a lot within what I call healthcare light. What we've seen from the private equity community is more and more a larger portion of private equity funds are being allocated towards healthcare deals. And it doesn't necessarily mean you have to have a deep understanding of the regulatory environment, the reimbursement environment, the payer environment, but there's companies that are looking at healthcare as end markets, whether that be imaging equipment service or contract manufacturing businesses that are selling into the medical device space, where there's a general understanding of the business, but you're getting access to healthcare as an end market, just given how dominant healthcare is in terms of our overall economy. So.
Okay, so that sounds like a pretty positive picture as well within healthcare. Kelly, you said you're focused on business and tech-enabled services, industrial growth, also healthcare like Addons. What's your outlook? Where are you expecting to see them deals this year?
Yeah, consistent with what's been said, also consistent with what Nadeem showed earlier. I think services is so broad, but in particular, tech-enabled services, ones that have differentiated technology across a lot of different end markets, the ones that Ridgemont covers, and then the ones more broadly that Larissa mentioned that Harris Williams covered. We've seen a lot of activity there. Supply chain services, it's been on the front page of so much over the last year. It's a very complex supply chain. There's a lot of different services that play into that. It's been extremely active. We expect it to be active for the foreseeable future. Residential services has certainly been an area of a lot of interest over the last 18 months or so. And then probably worth noting that all things ESG solutions that are playing into the ESG themes that we're now seeing more in the middle market. It's something that the institutional investment community certainly is focused on, and is more of a topic in the middle market.
And Kelly, can you give an example of that? Like, are there actual like ESG companies? Just to dive into that a little bit more, I'm interested.
Sure, yeah. I mean, at a high level, investors, private equity firms are much more focused on being ESG compliant, whether it's high levels of diagnostics or checklists as part of due diligence, but then also more specifically companies that are helping the ESG initiatives in the US, which have always lagged other parts of the world. So for example, Ridgemont invested in a company last year called North Star Recycling. They are an asset-light provider, logistics, facility service provider for CPG companies that are looking to move their organic waste away from the landfill and into more beneficial reuse applications. So that's a kind of an obvious example of how they are playing into those ESG themes, but you're seeing it across lots of different industries and business models, that it's a much more prominent topic.
Okay, so good. We've covered some industries we expect to stay strong next year or this year in terms of deal activity. Now we do have some economic indicators, economic clouds. We've got interest rates that are on the rise. We have inflation rearing its head. The stock market seems to be going the wrong direction the last few days. And Nadeem hinted earlier that he didn't hint, he says he thinks we're at an inflection point. So I want to get Nadeem to go into a little bit more detail on what he's predicting and how those changing dynamics could impact the deal market this year. Nadeem?
Well, happy to jump in a little bit more, David. I've been burned so many times in predictions, so one might suggest that they, strategize based on the opposite of my predictions. for increasing their chances. But I do see from a data standpoint, we had a record year in terms of deal activity, and I can understand and explain why that happened. The 2020 deals got delayed, pushed into 2021 because of COVID, and then people got more comfortable. Over 3 months ago, there was a real concern about tax rates changing. I think that pulled a bunch of 2020 due deals. I don't think that's a real threat anymore, but it was for a while. That pushed deals into 2021. So I see those factors. I understand why deal activity was so high and we're creating record levels, but what is going to happen in 2022 to make that sustainable? I don't see those factors next year. The one tailwind is that there's a lot of buyer demand. There's a lot of funds that have been raised, exits that have occurred. All that money, needs to be put back into the market. But I do feel like there's a little bit of a inflation occurring right here in the private equity world. I think there just aren't going to be as many companies to meet that demand. So you're going to see a lot of competition, and you're going to see prices paid go up. I can't see an environment where there can be a pullback in valuations because there's so much capital on the sidelines and people are just going to snatch up those assets. But I do feel they're just not, I feel like it's going to come back to maybe 2019 levels, which is a 10 or 20% drop. So for what it's worth, that's my view. That's what I see happening. I talked to private equity folks and investment bankers. The pipeline is very strong right now. And I think part of the reason we saw that median private equity deal flow drop so low in Q4 is that fewer deals were brought to market. People were just so busy. And I've heard it that they were pushed into 2022, and now I see it. I think that's the explanation for that drop in that chart. So I see a robust Q1 for these factors, but I do wonder about getting into the summer and beyond. I'm just not sure what's going to happen where we can either sustain this level or not see like a 10-20% drop. So that's what I see happening.
Okay, very interesting. Almost like what's happening in the greater economy, where demand is holding up, but we have supply chain issues, and that's driving up prices. So there's some parallels there. Adam, what impact do you expect the inflation, rising interest rates, stock market craziness to have on the deal market, this deal activity this year?
Yeah, thanks, David. There's a lot to unpack with that question, and I think some of the stuff that Nadeem said makes perfect sense. I mean, 21 certainly was an exceptional year from a deal volume perspective for all the reasons that he outlined. I think that typically when you see rising inflation, the expectation would be that it's going to have a negative impact on deal flow, and that's because of usually the Fed's reaction to inflation by raising interest rates and ultimately increasing cost of capital. I think there's a couple of other factors that make it a little bit more complicated in this market. I think the rising cost of capital is one thing, but you've got a ton of private equity capital sitting on the sideline, as Nadeem said, chasing those opportunities, and therefore I think that's going to counteract the rising cost of capital because there's going to be inflationary pressure on valuations. I think the other thing to consider, and just the overall psyche of business owners. I know private equity is a much larger percentage of overall deal transaction volume. We at Cascadia do work with private equity groups and think through liquidity events for private equity groups, but our core business remains working with owner entrepreneurs and closely held family businesses and consulting them, not just, hey, I want to do a deal today, but over the long term, what that strategy is for thinking through a generational transfer of wealth and thinking through liquidity events. There's been a fundamental shift in the psyche of a lot of family-owned businesses, and I'd say there's a lower propensity from what we're seeing in today's market to want to transition ownership from one generation to the next. And I think there's been a heightened awareness of just the overall risks that are beyond the control of a lot of entrepreneurs that have made the desire to go to market and find, you know, an institutional partner in private equity or a strategic buyer a more likely option for those families. And so I think that's going to help drive or continue to make the M&A market robust, at least what we're seeing through 2022 and probably into early 2023. So the other comment that you made, yeah, I mean, that's to us, that's really the impact of the ongoing pandemic. I think the initial impact of the pandemic was, okay, what does this mean for my business, right? And then on the other side of that, saying, okay, how do we manage this? And like in any disruptive situation, there's opportunity and there's going to be winners and losers, right? And we're seeing a lot of businesses that came out of the other side of the pandemic with really good momentum, but there's been a shift towards companies that benefit from the pandemic, and so it's just a shift of where that opportunity takes place. And I think I'm the benefactor of being in the healthcare space, and we've seen a tremendous amount of opportunity and continued volume in the healthcare space as a result of some of what's transpired in the macro environment over the last 24 months.
Yeah, if I could just kind of chime in here quickly, I agree exactly with what Adam said as it relates to, kind of the psyche of the private business owner. I also spend quite a bit of time, in those sort of conversations and talking with individuals like family-owned businesses. And one of the things that just seems to be a recurring theme over and over again is just that, the operating environment over the past 24, now 36 months have, and I hear it time and time again, people are saying it's just the most difficult of their career, of their experience with the business, and they're fatigued. So, I think when you start talking about where a business owner's mindset is, now they know things are probably going to be okay. We're working through the pandemic. It's starting to move into more of an endemic sort of dynamic. And people are becoming a little bit more comfortable and confident with that. But, what Adam said around, succession planning conversations, it does feel like they're ramping up. They were driven by capital gains fears, but I think the mindset is shifting now towards, I don't want to do this forever, and my kids don't want to do it. So, why shouldn't I be thinking about an exit? And typically when you see M&A cycles, at least what we've observed, you oftentimes see almost a first mover advantage with the institutional capital. Private equity, backed businesses, typically are the first ones that do come to market because, those professionals are looking at the same data that we look at on the investment banking side. They're seeing the markets are strong. They're seeing there's great leverage out there. They're seeing an abundance of capital, on the sidelines chasing deals. And, they start to take advantage of that. And it's almost a trickle down effect where it isn't until a private business owner sees that a company in their space has transacted at a premium valuation that, they think to themselves, well, gee, maybe I can get something like that too. So you almost see kind of a progression through deal flow. And in some respects, it's not uncommon to see those kind of private business owners, no institutional capital companies kind of coming in as the second wave of deal activity. And I think that that's really where, where we are and what we're seeing. But as it comes back to even conversations around interest rates and leverage, I mean, we don't really see too much of an impact. We think that, we're going to continue to see business as usual unless something, really seismic happens, but nothing like that's going to be on the horizon.
Okay. Thank you, Adam and Larissa. And now I want to turn back to Kelly because we did get a follow-up question from someone in the audience on the subject of ESG, which you were discussing earlier, Kelly. And that is that when you're evaluating a company to purchase, how do you measure ESG at that level, at the investment level? How are you able to demonstrate ESG in the business model? Tell us what you can.
Yep, sure. So there are multiple third parties that help with some of this evaluation, that help add some credibility and specific metrics around how we might approach ESG during the diligence process. but just really broadly speaking, we think about ways to maximize resources and minimize impact. And there's a lot of different ways to look at that. I mean, most of that activity falls on the industrial or environmental utility side. Things that are on the right side of multiple trends that we see around the smart grid, around renewable energy. We have been very active around all of those themes for a while, and mindful of that, and we're, for the middle market, I think pretty early on performing diagnostics within our portfolio, not just on the environment side, but also other things inside the portfolio about employee base and policy and cybersecurity. So there's a portion of it that is checklist oriented, and there's also a portion of it that's based more on materiality of the effects that us as stewards of capital have across our portfolio.
And Kelly, I want to stick with you. Go back to sort of a big picture question. From your perspective, Kelly, since the pandemic started, how have auction processes changed? And how are you responding as a firm?
I would say that a few things that I think are probably fairly consistent with what others see. There is more of a propensity to have multi-step processes where there's a smaller group of buyers that a banker might go out to early, or a business owner before they hire a banker, doing some early work around what a private equity partnership might look like ahead of even engaging in a process. So they're multi-step. There's less of a clock on the early end, but speed and certainty still really matter. So building that conviction early, for us as we think about what might be ahead in our pipeline that we're tracking across our three industry groups, from the banking community, but also some direct dialogue with sellers, and we are thinking earlier and earlier about why Ridgemont as a capital partner. How can we differentiate ourselves? Why should we be the most competitive? And the biggest piece of that is thinking about the growth strategy and how we can achieve the returns we're ultimately looking for and the time horizon we're looking for. What's our set of experiences, our playbook, our ability to understand business models and end markets to really achieve that level of growth. And we're growth-oriented investors. It's a hot market, as we've discussed. So that bar is higher and higher, and having to build out that growth plan ahead of time. That's a big piece of it. Making sure you're like-minded and a good cultural fit with the management team, with the relevant parties in a transaction, that everyone feels like it's a good use of time, because that clearly was the scarcest resource last year. I think a big reason for that dip in new deals launching in Q4, as Nadeem said. So thinking about opportunity costs, how to use our time, and then really that differentiation point about us as a partner. And most of that is around ability to execute growth plans.
Yeah, Kelly, if I could chime in really quick as well. I would absolutely concur, and I think from an advisor's perspective, it's imperative that when we're thinking about going out to market and talking to private equity groups, if that's the type of transaction that we're looking to do, that we think about what the angle is and what want to demonstrate to private equity groups that there's an opportunity for them to win the day. I mean, a couple of years ago it was far more common to solicit initial indications of interest and for private equity groups, at least from my seat, to take a meeting trying to learn more about the business. And you may have 7, 8 meetings or more, and ultimately that yielded a handful of letters of intent because there's a down select process. I think from our seat, time is scarce. I think private equity groups and buyers in general are far less likely to hop on a plane and go spend time face to face unless they think they have a real opportunity to win, and unless they have a really good understanding of the business coming into that process. And so from an advisor's perspective, we're doing a lot more to front end load a lot of the diligence, share more information, ahead of management meetings, such that those meetings can be that much more productive, and probably not have as many of them, just to make sure that whatever meetings we do have are really about going deeper with the company and ultimately yield a definitive letter of intent coming out of those meetings.
Mm-hmm. Another thing to add, this is something that's certainly close to our hearts here, is these relationships really matter, over the long run, in reputation and behavior and processes, partnership style, and it would have been hard to be a new entrant to the market on the banking or the principal investing side over the last couple of years.
That's a really good point. And Larissa, do you have any advice to sponsors that obviously want to get as early an insight into your pipeline as possible and start building that relationship early? What do you suggest?
Yeah, I think, I'd echo some of the same comments that Adam, just mentioned. We are in a, obviously hyper competitive market. Valuation and speed and certainty to close are the clear differentiators across the board when we think about, transaction conversations. So buyers are really figuring out ways to kind of carry the day by almost compressing deal timelines. And that all translates back to, what Kelly talked about, having, industry expertise, a very clear, kind of focus, and a very clear message, to us as investment bankers, as intermediaries, where we understand and know where a sponsor is focusing their time, what their valuation range is, where they're willing to head. All of that is information that's enormously helpful to us. So when we are putting together a buyer's list, it is about having, the most productive and most engaging and effective conversations and touch points as possible, because as Adam mentioned, the days of being in a position where people have the time and the ability to educate themselves about a new industry or perhaps an area where they haven't spent any time before, this is not the market that's going to allow for that. So, firms that have done particularly well really have sharpened their pencils, not only in terms of identifying, what sectors are particularly interesting, but, maybe areas where they've owned businesses before, situations where they have market knowledge and the like. So those situations are going to be ones where, those sponsors can run faster, run harder, and then obviously differentiate themselves. So, our advice and our request of the deal community is certainly just to keep us apprised of what those objectives are, because as Adam had mentioned, we are thinking about much more selective engagements. Part of the request of clients are asking us to have fewer buyer touch points, and when that outreach becomes more narrow, you have to be acutely aware of who you're bringing in and have a reason why. And then from our end too, as we think about just having conviction in those parties, it comes back to the points about quality reputation. Folks that behave well, engage in a trustworthy and respectful sort of way. All those factors kind of come into play when we think about it. So it's very hard as an advisor to advocate for somebody if that information isn't sort of front and center. So I think the other piece too that's worth touching on, just again kind of coming back to the hyper competitive nature of the environment, we've seen a couple things emerge from the sponsor community in particular. Folks are, again, they're looking to, compress the deal timeline, figure out how to take the deal off the table early, which all translates back to having a very clearly defined investment thesis. But the other piece too is, folks are starting to demonstrate a little bit of flexibility. They're being more willing to, sign and close through small dollar open diligence items, for example, things that, they're not sweating the small stuff anymore, which perhaps might have been a hang up that could delay a deal a week or two in years past. So there are certain areas where we're seeing a lot of that momentum. And then the other piece too, private equity in particular, they're doing quite a bit of a buy-side engagement with investment bankers. We're seeing more and more requests on that front, not only from a market expertise to help through valuation and the like, but also just from a diligence perspective, having more arms and legs to help run that process and navigate that more efficiently, again, with the goal of compressing that timeline. So, there's been a lot of different strategies that we've seen, but at the end of the day, I mean, communication. That will always be, I think, everybody's best friend.
Thanks, Larissa. Kelly, I saw you reacting a couple of times during what Larissa was saying. And I wanted to follow up with you on whether you are using buy-side investment bankers more, or whether you're doing anything new in terms of deal sourcing that's working well for you.
Yes, we are using Buyside Advisors in the context that Larissa was mentioning, in terms of firm relationships that we link arms with to help us position, understand the some of the growth opportunities out there. You fast forward several years as we think about exit opportunity, some advice from tactical experts around how to position for a process, how to spend time. There's obviously a relationship component of that, having friends around a new business early. It's just more and more active. It's another way to be a good client, is to create opportunity for some of your closest relationships on both sides, sell side and buy side. And then separate from the buy side engagement that Larissa and Adam were referencing, are buy side research firms. There's more and more of those popping up. It becomes an important piece of diligence. Again, going back to the point about building that growth story early, just understanding how fragmented a market is, what the white space really looks like, what a calling effort could look like for an M&A strategy post close. So we are doing all of those things, and there's lots of different tactics about how to access opportunities and be positioned to be that most competitive buyer. But it's some of the same things we talked about years ago, but it feels like it's more prominent today.
Yeah, I think it's reflected in some of the numbers that Nadeem showed earlier, right? There's just more add-ons relative to platform investments. That's seemed to be the trend of the poll that you took earlier as well, David, that people expect more add-ons, right? And so I think that's one of the reasons that there's more buy-sided work being done, and investment banks doing work with private equity groups to identify who those add-ons might be, and doing some of the upfront research and diligence to develop and curate a thesis in the space that they're going after.
Right.
I had a quick question, if you don't mind, David. Something Larissa made a lot of great observations, and one of the things she said about processes and having fewer buyers, because this is a question that comes a lot from our clients, and I don't always have my finger on the pulse. So it'd be great to hear, both from the sell side and buy side, has the mindset of your clients on the sell side, or even your firm's mindset, changed about broad versus more narrower processes? Like, meaning, in the past, maybe that was an important aspect of your firm, the ability to go broad. Has that shifted in your mind and your seller's mind? And then for Kelly, like, on the buy side, is that, how important of a factor is that when you get a deal from Larissa or Adam? Like, are you going broad? Is it going quiet? Is one more attractive? Has there been any change in that? It'd be great to get some comments.
I'll take first stab at that, Larissa, and then maybe you can chime in. Yeah, there has been, I wouldn't say it's been a shift as much as it's evolved, right? It's evolved over the last couple of years, and like in any situation, you got to adapt with the market, right? And from my perspective, when you're having those initial conversations with private equity groups, if they're one of 400 private equity groups that are looking at an asset, they're less likely to engage. And so there needs to be a viewpoint that they have a thesis, they have an angle, they have a chance to win, right? And even if you told them that they're one of a dozen meetings, post IOI that are taking place, I think there's less likely for them to engage in that upfront diligence and spend not just the dollars, but the time and resources to get smarter on that specific company. So it absolutely has evolved. I think from my client's perspective, it's evolved as well. I think that, in this environment, time is absolutely, essential, and doing a broad auction is less compelling for a lot of my clients, I think, than it used to be. And part of that is ultimately the way we position it and the way we manage those client relationships as well. But for me, it hasn't been a fundamental instant shift, and every client situation is a little bit different, but the thinking has absolutely evolved to be a much more curated, thoughtful list. And the reality is, once you get above a certain number, it's sort of diminishing returns anyway. If you're thoughtful enough about who you're reaching out to, and back to Larissa's point, which was spot on, it's all about communication, and the relationships that we maintain with prospective buyers. That as long as you have that communication open, and you know who has a thesis and who has an angle, a much more curated list, I think, is a better strategy.
Yeah, I think just kind of maybe even answering the question on the other side from a client perspective, Adam did a great job, obviously what he just walked through, and I agree with everything he just said. We've had a lot of directive on the client side. There is a concern around confidentiality. There's concern around, the timeline and the extension that having a very large buyer universe, would ultimately imply to a deal. So, we are constantly thinking about ways to increase, the speed and certainty of close. And certainty of close comes back to who's going to be the buyer that, you have conviction around that will ultimately stand up at the end of the day. But we have seen quite a bit on the client side of really a desire to protect management's time in particular. So to Adam's point, the days of doing 12 management presentations when they're all-day commitments, you've got a dinner the night before, that's exhausting and it's distracting for management. The one thing that a business can't do during a sale process is underperform. So they really need to be hyper-focused on doing what they do best, so that the outcome will be what they're looking for. So it really has been, to Adam's point, it is an evolutionary thing. It was not a flip of the switch kind of dynamic, but it is something that we continue to think is going to be the trend of M&A. And at the end of the day, you could make an argument it's almost creating a more efficient market. While folks aren't seeing the breadth of deal flow, typically what they are seeing as a result of the communication and making sure that they are on the short list tends to be more down the middle of the fairway. And so you get more engagement, you get more enthusiasm. And, selfishly, as a sell-side advisor, that translates to better outcomes for our clients as well.
Yeah, it's interesting, Larissa, just an anecdote which might be helpful. A couple of situations and clients that I took to market this year were clients that I took back to market because we decided a few years ago not to do a deal for whatever reason. And in one in particular, we went far broader than we should have the first time around and yielded a number of indications of interest, a bunch of management meetings, and ultimately a deal that advised the client that it didn't make sense for them to take at the time. So there was an education process when I went back out to market. When I went back out to market this year, I think I might have. Can you still hear me, David?
We can hear you, Adam. We are getting some pinging noise.
Yeah, it looked like my computer just shut down. But we went back out to market. The first time around, we had 12 management meetings, which ultimately led to 2 LOIs. This time around, we went to a list of probably 10% of what we did the first time, and it led to 5 management meetings, all with much better LOIs, right? And it's just because of the thoughtfulness that went into how we're running that process and who we're talking to. And back to the point I made earlier about, making sure that there was a significant amount of diligence that was done prior to those management meetings happening. And ultimately, making sure it's communicated that each of those parties was really in the mix and had a chance to win the day. But there is an education process with the client when they saw something the first time around with a far higher number of initial indications of interest, and what that meant, the second time around when it was a much lower number, but ultimately a higher value and more solidified offer letters.
Kelly, can you weigh in as well? And I may be oversimplifying things, but does that mean that firms like yours are getting maybe picking their spots, getting choosier about where you put your resources? What does it mean for you?
Yes, absolutely. I'd say in a very crowded, hyper-competitive market, thinking about level of conviction, back to what we talked about earlier, and then that level of actionability. And a lot of that comes from having a trusted relationship with the people involved around it, around the proper guidance, knowing that they want a successful outcome and they're representing their client, but just getting that guidance is really important. The stats that we track on the flip side that are related to this buyer behavior that Larissa and Adam mentioned, we think about how we convert from as we think about KPIs, we think about how well we can convert IOIs to management presentations, meaning, are we spending our time in the right areas? Are we competitive enough to get a management presentation? And are we someone that the advisor and the seller wants in their process? So we want a high number there. And then we know that often the people on the other side are looking for high numbers from management presentations to further engagement, whether it means a check bid or an LOI, and ultimately having the high conversion all the way through closed. And the recognition that that has been monitored for years and years, and now there's enough data points to draw conclusions about who should be around the process. We're very mindful of that. We are going to spend our time accordingly, and sometimes you need to get materials to learn about a sector, but you're not necessarily going to place a bid on that one, but it's all part of the learning. But we really think about our ability to convert further down in the funnel.
Okay, we've got about 12, 13 minutes left in the program. I do want to make sure that we get to any live questions from the audience. So please take advantage of the question feature on your control panel and ask your final questions. And we've got plenty to kind of sustain us to the end of the program here. Nadim, could you build on what Kelly was saying on KPIs, and just one of our registrants would like to know sort of what are the most popular sourcing KPIs that sponsors use these days?
Yeah, this is a pretty big topic right now. We're getting more and more inbounds about what are the right KPIs. And in our view, let's go back 3 or 4 years ago. The most common KPIs on deal flow were just deal volume. I saw 700 deals last year. That's up 30%. That's up, down 10%. We have this many contacts in our database and intermediaries, but our messaging for a long time has been, well, what does that really tell you? Are those qualified deals? Are those, deal flow goes up? Is that just the market being stronger one year or the other? So first and foremost, we talk about its mind share of the right deals that you want to see, and it's not always easy to filter for the right deals, but to the best of your ability, look at what's taking place in your market, and in the aggregate, by sub-vertical, by intermediary professional, and what share of mind. So we call that market coverage. And then how is that trending? Is it going up? Is it going down? What is your share of limited processes versus broad processes, by geography, by sub-vertical, and look at those trends. Now, those are kind of our standard KPIs, and we generate those for all our clients. But then there's KPIs that are more customized for clients. And just recently, we did a case study, and the client that we did it with had this concept of intermediary conversions, he called it, and that's not something we were familiar with. From his perspective, that was, based on his work with us or deal sourcing in general, how many intermediaries was he able to convert from, yes, they're in my database, to actually show me a closed, a good, relevant deal. So that was how he was measuring it, and that was very important. And so we learn from our clients too. It's no one kind of size fits all, but the whole concept of looking at KPIs and taking a very results-driven approach, which is becoming more and more prominent in private equity, is very encouraging.
Thanks, Nadim. So interesting developments on the measurement front. We have several questions that have come in related to proprietary deal flow and just how much of that is going on. And Kelly, I wonder if you could tackle this. The specific question is, what are your thoughts on origination from cold calling? Are you calling business owners directly, either for add-ons or platforms anymore? Or have you ever? What can you tell us?
So we do less direct calling into businesses than maybe some other funds do in the lower middle market. I'd say it is increasingly difficult with how efficient the market is, with how well investment bankers have gotten in touch with these businesses ahead of time. We do that less on the platform side. From the size that we're looking for, which is typically businesses with, call it 10, 15 million of EBITDA, or on the tech side, it could be, call it 15, 20 of ARR. Those are usually a little bit more scaled businesses. So a lot of those folks hire intermediaries to some level. We are doing that research to know what businesses are out there, whether they're founder closely held or private equity. On the add-on front, it's a different story. Adam mentioned earlier in the healthcare sector, the amount of activity in the especially physician world. That's a really, really fragmented sector, and a direct calling effort that involves both the Ridgemont platform and the deal teams and the company at the corporate level, but also some of the doctors that are consolidating their practices, and that amount of word of mouth. So those things all play on each other, and we try to do things to be a catalyst to all of those activities. We have done less sort of cold calling and direct calling than maybe some others, but our big governor is sector. And then in the portfolio companies where M&A is a big piece of the growth story, we engage third parties to help us with that outbound effort. And then often some of the best opportunities are coming from the management teams of those businesses, where they've had a list for years of companies they'd love to approach in the sector, and just having more capital, fresh eyes, a team that's well-versed in transacting and integrating becomes the catalyst for the opportunity.
Well, I will tell you, Kelly, it seems from my seat, and I don't know if Larissa agrees, that there is a lot more direct calling efforts on behalf of private equity, whether that's their portfolio company for add-ons, whether it's the business development people, or as we talked about earlier, Buyside Advisors that are calling companies directly. So you're right, it does seem to be an efficient market from bankers calling directly on companies, or having had those dialogue before talking to private equity, but it's also very efficient, I'd say, on the direct calling side. A lot of situations, seemingly increasing number of situations lately, where I'm getting calls from attorneys or accountants that there's already a private equity group that's put an offer in and said, hey, does this make sense? Do you guys want to get involved? And that's where you could do. We will get involved quite often and say, we're not going to necessarily take it out to market, but at least help that company through a process. And hopefully that's oftentimes viewed as a positive from the private equity group, even if maybe sometimes you have to pay a little bit more. But we definitely see that happening quite a bit, and an increase in probably proprietary deal flow, and at least direct calling efforts on behalf of private equity and the Buyside Advisors.
Yeah, I would definitely agree with that. And I think, coming back to even some of our, opening remarks on, today's conversation, when we were talking about just, where we think 2022 is going to shake out. I think that, that direct calling effort is having a conversion rate. We are hearing a lot of folks just say, my phone rings daily. I get an email, a couple times a week, that kind of stuff. And then to your point, Adam, when there are those preemptive offers that get put on, the table, oftentimes people are pleasantly surprised. They just didn't know they're sitting on, an asset that could be worth that amount of money. And suddenly it does very quickly translate into a, let's explore this further sort of conversation. So I agree on all fronts with, with what you outlined there, and without question, think it's certainly going to continue.
Mm-hmm. I'll add one more point there. I'd say our direct calling efforts have been less routine, but we have converted a lot. We do have a fair number of proprietary sourced deals in our portfolio companies, and in a lot of cases, it's because of this industry knowledge and referrals, but also having different transaction types, having a recap where maybe it's still a majority recap, but there's a sizable role from the prior owner where that partner really matters, or a growth capital raise where it's a minority recap, but there's less need to maximize value because the ultimately being aligned on that second bite of the apple is what matters. So the success stories are there, but we have less of a formulated effort around it. But it is interesting, and people are doing it and tracking it, both for platforms and add-ons.
Okay, so it sounds like the battle continues for proprietary deal flow out there. No big surprise. Healthy battle, exactly. We got a really interesting question that came in. Maybe I'll give this to Kelly. Of course, the whole idea of a platform, buying a platform first and then doing add-on acquisitions, or at least one big reason, is to lower your the multiple that you pay over time. Is you're getting buying the smaller companies for lower multiples. But this questioner says now that there's so much attention on add-on acquisitions and private equity firms are devoting so much resources to that, and so much calling going on, these business owners, even the small ones, is that arbitrage going away? Kelly?
Not in our experience. Not in our experience. I mean, there are one-off examples where having an accretive multiple is less of the reason to do it, but just sort of by nature of what the add-on opportunities look like, from customer concentration, scale, geographic concentration, all those things tend to lead to a multiple that is something like, call it half or so of the platform. But there's exceptions to that, and that is becoming difficult in areas where there's a lot of data points around other similar sized businesses transacting. So, but purchase price multiples are going up for the platform, so those things might move together. The power of synergies. We did a pretty transformative merger inside our portfolio last year, and a lot of the excitement around the merger was around the synergies and not around how accretive the multiple was.
It's a really good point, Kelly, because I was going to bring it. We've seen this happen where private equity groups will think about the add-on arbitrage opportunity as a reason for being able to get more aggressive on the portfolio, the platform investment, right? And that's obviously good if you're selling the platform investment. It's also risky, and it's not something we've talked a lot about today, but when some of these deals, because of the robust markets, are priced absolutely to perfection, that to be able to manage that and also close efficiently is not always easy.
Okay. We're just about out of time. I have 1 minute left, so I want to give Larissa and Adam 30 seconds each, just to give maybe some advice to sponsors out there that would like to get on your radar, want to have a better relationship with Cascadia or Harris-Williams. What's some quick advice that you can give them? Adam, we'll start with you, Larissa. You get the final word.
Yeah, thanks, David. Look, we're a really collaborative group of 17 MDs, and we're growing. And I recognize amongst the private equity community that as we've grown as a firm over the last couple of years, that becomes more difficult to manage, because you got to manage across different industry groups. What we're doing at Cascadia, candidly, is we're implementing a more organized private equity sponsor coverage. In fact, we've made an offer and had an offer accepted for somebody that's going to be joining the platform in March, which I think will be probably first and foremost the easiest way to get in the mix with our deal flow. We at our core are a relationship-driven investment bank, and I think maintaining relationships with the bankers that are within the specific subsectors that you're interested in is also going to always be key. We tend to go not just the broad industry group, but we tend to go a little bit deeper within sub-industry groups, and healthcare is a really good example of that. So, we obviously want to be having regular dialogue with the private equity groups that we know well and that understand our industry groups, but we're trying to make that easier in the near term with some sponsor coverage, which I think will be a good first step.
Yeah, I'll close out quickly and say that, without question, what Adam just highlighted is certainly fair. We have had the benefit of an organized sponsor coverage effort for quite some time within our firm, and it is extraordinarily collaborative across practice areas, across titles within the banker roles and the like. So communication internally is something that we strive for as well. So when it comes to frequency of communication, more is more. We really do pride ourselves on making sure we're maintaining regular touch points. We want to know, what folks are interested, when they're interested in them. Certainly we view ourselves as being a resource and a thought partner. And we do try to engage, really early in the investment life cycle within a sponsor engagement. So, where we can add value along the way, whether it's 2, 3, 4, 5 years in advance of a potential exit, that's something that's extremely important as well. And, I think that collaboration helps both sides, certainly when we're plugged in, with industry verticals and subsectors that, we're very active and involved in. So, on the how to get on our radar screen, it really just comes down to, to collaboration. We certainly pride ourselves on making outreach, front and center to our efforts, but we would certainly encourage and be receptive to the reciprocal of that. So the more we can engage and again have that clear line of visibility, the better we're going to be in terms of getting the right opportunities in front of you.
All right. I'm afraid we are out of time. We heard some great themes being discussed for the first time that I can tell, including the sort of ongoing loss of broad auctions and so many more. But I'd like to thank everyone for coming, all the attendees, all the registrants. I'd like to thank our sponsor, SBS by Bain & Company, for underwriting the webinar and making it possible. I'd like to thank our speakers for doing such a good job with the program. Nadeem Malik of SBS by Bain & Company, Kelly Lineberger of Richmond Equity, Larissa Rozicki of Harris Williams, and Adam Stormone of Cascadia Capital. Everyone enjoy the rest of your day. Take care.
Thanks, everybody.
Thanks.